It's a great pleasure to see you all there for the second conference of our series on the G20, launched earlier this year in the context of the French presidency of the G20. Having just 1 week ago taken my new position as French ambassador to the UK, I'm delighted to take over this initiative from my predecessor and friend, Maurice Gourdeau-Montagne. We were encouraged by the feedback received on the opening conference on February 23rd, and given the impressive panel and the distinguished audience tonight, I trust you will find tonight's event no less interesting. I would like first to express my gratitude to our partners, of course the Financial Times, which agreed to hold this event on its premises, and to provide world-class individuals to moderate the conferences, as you can see tonight with Martin Wolf, a living legend, at the table. But also Chatham House, with whom we have been working closely. I had the pleasure of attending a Chatham House dinner on the G20 on my second day in London, and of course the LSE, the Institut Français, and the Franco-British Council. I'm also extremely grateful to the panelists. I mean, you will recognize some of the best experts and minds here to discuss today's topics, and I'm particularly thankful that you could find time to come from London, from Paris, dear Jacques de Larosière, or as far away as Beijing, Madame. Well, as you know, these G20 conferences are a forum for discussing priorities, raising objections, agreeing maybe from time to time, and contributing ideas. And for the French presidency, having more ideas during the course of this presidency is something extremely important. You know that the G20 summit will take place in Cannes on November 3rd and 4th, so now it's the time to act and soon to deliver. So turning now to substance. The G20 has long been active on economic and financial issues, but the 2008 crisis raised the stakes dramatically. It became the business of heads of states, and President Sarkozy played an instrumental role to the effect, and has remained so ever since. But for all its powerful members and renewed relevance, the G20 faces daunting challenges. The international monetary system must accommodate the rise of economic powerhouses in Asia and Brazil, growing imbalances and risks posed by sometimes increasingly uncooperative monetary policies. It must secure financial stability while at the same time responding to the outrage caused by the bank's responsibility for the crisis. So, can the G20 help address imbalances? Can it avert so-called currency wars? Can it help to achieve a more salient role for emerging currencies? Can it help shield vulnerable countries against destabilizing capital flows? And it was the case in my previous assignment in Turkey. Should that include capital controls, as recent IMF thinking suggests? Has the G20 gone far enough on financial regulation? These questions seem intractable, particularly in a new, large, and sometimes awkward forum like the G20. In a forum where players are big and status conscious, where they are constrained by domestic politics and sometimes unaccustomed to negotiating with one another. There is progress, though. A lot has been achieved already on financial regulation, with Basel III, the Financial Stability Board work on remuneration. More recently, the G20 Finance agreed in Paris on a list of indicators to measure imbalances. And as you all know, in a fortnight, the spring meetings in Washington will discuss the guidelines on the basis of which indicators will be assessed. China, responding to a suggestion by French President Sarkozy, also hosted for the first time a high-level seminar on monetary issues in Nanjing on March 31st. But there is still a lot to do. And I will leave you in the hands of Martin Wolf, who will tell us exactly how much the rest we can achieve. But before that, a few words on the next conferences. I have to do my own marketing, of course. On May the 10th, we will discuss the Internet and its governance at the Institut Français. Then, commodity price volatility on the 1st of June, also at the Institut Français. Then, African development in late June at the LSE, and a cycle of conferences will conclude on October 11th with a conference on climate change with Lionel Barber and Lord Stern. And finally, because without them, I mean, nothing would be possible, I would like to thank our sponsors. Without their invaluable support, this event would lose some of its French touch. And special thanks, therefore, go to Eurostar, Mouette NC, United Kingdom, La Durée, and La Fromagerie. With this, ladies and gentlemen, excellencies, let me wish you a very fruitful discussion and a pleasant evening, and I leave the floor to our dear moderator. Thank you.
Thank you very much, Ambassador. I'm delighted to and very privileged to moderate this session. Let me first describe how we're going to proceed. We're going to have introductory remarks from the four speakers, who I will introduce in a short while. Depending on how long that goes, we hope that I might ask a couple of questions starting at about 7:15, and we'll then go to questions from the audience. Discussion will end this at 7:45, whereupon it looks as though we will have some immensely enjoyable consumables. No doubt, as has already been said, all of them from France, than which nothing could be better. So that's what we will do. I'll just introduce the speakers and then make a couple of very quick comments about the subjects, which are, of course, as you will notice, very, very broad. On my far right is Jacques de Larosière, who has, of course, been, among many other things, head of the International Monetary Fund, managing director, head of the Banque de France, and head of the European Bank for Reconstruction and Development. Quite simply one of the most important economic policymakers of the last generation. Next to him is Rachel Lomax, who was both a very senior civil servant and Deputy Governor of the Bank of England, a job which I think she quite particularly enjoyed. Next to her is Gao Haihong, who is a senior fellow at the Chinese Academy of Social Sciences, and for those who don't know, that's a very, very important institution in the Chinese system. And she works very closely with somebody whom I regard as a particularly close friend, Professor Yu Yongding at the Academy. And finally, immediately to my right is Jonathan Portes, who is now director, I think, is that the title, of the National Institute for Economic and Social Research, which is really the granddaddy of all economic research institutions in this country. Was very, very famous when I was a child. Immensely prestigious, and was formerly in the civil service, also many positions, and ended up in the Cabinet Office, if I remember correctly. Just to introduce the topic, we are supposed to discuss both the international monetary system and reforming financial regulation, and obviously in many ways these are different subjects involving very different sorts of expertise, and both very technical. But I suspect from what I've seen that most people are going to focus on the monetary system. I would just like to say that I am one of those people, and I've written a great deal about this, who think there are quite important links between the two, and in particular, among many other things, that the failures of the monetary system and the financial system together caused quite a large number of emerging countries, though this was not the only reason, to decide over the over the decade roughly leading up to the financial crisis that the rational policy was to accumulate enormous currency reserves. World currency reserves rose from about $1.6 trillion to over $7 trillion in the eve of the crisis. This was associated with, of course, the emergence of very large current account surpluses and capital flows in the form of those reserves to developed countries, and in my view that helped create the background conditions for the extraordinary credit explosion and asset bubbles that ended up in the crisis. That doesn't mean in any way that these are the only reasons or that the financial regulatory failures are not central to it, but I think there is a close link. And if we look at the future, one of the things we need to do, I think, is rebalance the world economy, and that does raise very fundamental questions about the functioning of the reserve system and the monetary system. Incidentally, by the way, I think it's one of the most remarkable features of the system that though during the worst of the crisis, this insurance turned out to be quite valuable for the emerging countries. Reserves only fell by a little over $400 billion from in the few months leading up to February 2009, and since then they've gone up by another $2 trillion. Now well over $9 trillion of foreign currency reserves have been accumulated, much of it obviously in the form of claims upon the US. So anyway, with those just very brief introductory remarks, let me turn the floor over to Jacques de Larosière to make the first introductory statement about these topics.
Thank you very much indeed. Monsieur l'ambassadeur, je vous remercie d'avoir organisé cette réunion. C'est à l'honneur de l'ambassade et de notre pays. I will be as brief as I can. I'd like to explain how I see the basic conditions for a good functioning of what would be a true international monetary system. And in doing that, I will be saying a few words on the gold standard, which I think is the only true experience of a cohesive international monetary system. So there may be some lessons to draw from that experiment. The second question is, can we, in a completely different context, reach some basic conditions that would allow the functioning of what we call the monetary system to be, I would say, normal. And the last point is, absent a positive response to the second question, no, I don't think that it is in the cards to have a system that has the sort of basic conditions that are needed. Then what could we do? And my answer is gravitates around financial regulation. Now, what have been the key key elements of the functioning of the gold standard? You know that the gold standard has stabilized the exchange rate system in the second part of the 19th century until actually the First World War, and has played a very important role in fostering economic growth. The system was basically built on three pillars. The first one was that abiding by the rules of the gold standard was a voluntary act. But it happened that the large countries of the time, which were relatively balanced, you didn't have an absolutely predominant player, all wanted to have their currencies convertible, and in order for them to be convertible, they had to be linked to gold. It was a condition for having, I would say, influence in matters pertaining to trade and finance. The second pillar was that the system was self-disciplinarian. That is, if you had prolonged deficits of current account balance of payments, you were automatically sanctioned by what they called gold leaks, and therefore, since the reserves held by countries were limited, you had to adjust your economic policies in order to correct those causes of deficits. And the last pillar was that constraint that was imposed by the gold standard was not amenable to any negotiation or tinkering. The system was, in a way, binary. Either your currency was linked to gold, or it wasn't. And in the second case, your currency could not be a reserve currency, nor an instrument for international payments that would be worldwidely acceptable. The system was far from being perfect. Indeed, it depended, in order to provide the world with sufficient liquidity, on gold production. And more importantly, I think, it was asymmetric, because the countries which had surpluses could accumulate gold without incurring sanctions, whilst the deficit countries had to adjust. Now, this system, which presided over the first globalization, which had many common traits, let us not forget that with present globalization, collapsed in 1914, and all the efforts made in the 20s and the 30s to reconstruct it were to no avail. Nationalism, mercantilism, competitive devaluations, beggar thy neighbor policies, name them, prevailed. With Bretton Woods, an indirect form of gold standard was put in place. The dollar was the center of the system. All par values were defined vis-à-vis the dollar with a fixed link that could be adjustable under certain circumstances. But the counterpart of that system was that the dollar was convertible in gold at a fixed price. That system survived, and this is very interesting because I think it is the lesson. It survived as long as the United States followed an economic and monetary policy that was balanced and non-inflationary. But with the 60s and the Vietnam War and social expenditures, the imbalances, the financial imbalances of the United States created a very strong confidence crisis against the dollar. And the dollar outflows from the United States eventually led the government of Mr. Nixon in August 1971 to de-link the dollar from gold. They couldn't take the convertibility link anymore. Therefore, a world of floating currencies, which were more or less linked to in some form or another to the dollar, prevailed since then. After a period of very strong volatility and inflation in the 70s and the early 80s, the system sort of tamed itself through what we can call the influence of monetarism versus Keynesianism. But, and this is the point that I would like to get across, because it is a point that I don't see very often made. With the enormous increase in banking leverage is the utilization of your capital through more and more exposures. With the enormous increase in leverage, and therefore the explosion of credit, which were favored, facilitated by the phenomenon of deregulation, monetarism was only walking on one foot. It could increase interest rates if it felt that there was too much overheating, but it couldn't act on the quantity of money, because the quantity of money was a function of credit creation. We used to learn in our books, when I was a student, that loans make deposits. And indeed, loans do make deposits. And the true source of money creation was through credit expansion. Therefore, monetarism, which in the 90s had been seen, perceived as the cement of this very fragile floating system, was in fact discredited by the magnitude of the development of bank credit. Now, of course, this phenomenon of the enormous increase in credit cannot be explicable if you do not look at what the Federal Reserve System in the United States did, and if you don't look also at the major balance of payments imbalances that were contemporaneous to what I'm explaining. And it is this enormous credit bubble associated with this laxity of monetary policy that explains the 2007-2008 crisis. To make the story short, the system, quote unquote, because it was not a system, that we called sometimes the international monetary system, had nothing in common with what I think was, in a way, the harbinger or the manifestation of the essence of a monetary system, that is the gold standard. You had no common discipline to reduce or eliminate, if needed, imbalances. Each country had the choice, either letting its currency float or attaching it to another currency. And the international de facto currency, that is the dollar, gives to the monetary policy of the United States an enormous predominance in the functioning of the system. You could say that the international monetary system is in fact managed in a certain fashion by the decisions of the Fed. Now, we see the results of this non-system. We have a lot of volatility in exchange rates. We have capital movements that are, in some cases, very disorderly. We have even misalignments of exchange rates, which leads to competitive problems. We have this currency war and reactions towards controlling capital. Now, if this analysis is correct, what can we do to bring together some of these fundamental conditions that explain how an international monetary system can function? Now, in the world of today, I don't think returning to the gold standard is a possibility, because there are a lot of drawbacks in the gold standard, and I'm not a proponent of this return. I also think that in a world where capital movements are enormous, free, and where I would say the liquidity of markets, and I'm speaking essentially of the United States markets, are the determinant criterion for the success of being an international currency. And in a world composed of states of which nationalism is a growing characteristic, and who are desirous to preserve their interest, or what they think are their interests, without accepting external constraints, you have all the conditions not leading to an international monetary system. Now, in order to imagine a true international monetary system in a world that doesn't go back to gold. I think the last element that I cited, that is a world of nationalist states that don't want to be told anything by anybody else, that element has to change. Because the word system, if you go to its origin, implies the acceptance of a minimum of recognition of a certain logic, external logic, if you will, that is imposed on the players. The juxtaposition of national individualistic positions cannot create a system. It can't create it in physics, in chemistry, it cannot create it in finance. Now, the condition to have such a system, or the elements of a system, is that the member states accept to coordinate their economic and financial monetary policies to install a better macroeconomic equilibrium worldwide. And that can only be under the aegis, the surveillance of an international organization that would have real powers, and in particular sanctions. The IMF, in order to exercise such a role, if one decided to give it that role, would have, of course, to better reflect the reality of the world and the importance in particular of the Asian countries. Now, this is, in theory, it's not something that is out of reach. But there is one condition, and that is that the states should be convinced that the disciplines to which they would, by which they would abide, would be not only desirable from their standpoint, but also desirable from the international standpoint. And I think this is a possibility. Now, to tell you the truth, and I'm speaking here not as a French official, which I am no more for the last 20 years, but I think the probability today, I'm not saying in 10 years' time, but the probability today of seeing countries like the United States, China, agree on this sort of distribution of roles macroeconomically that would lead to a more peaceful system, I don't think the probabilities are actually very high. So, and this is my conclusion, barring an accord that I have very briefly delineated, certain things could be imagined. Some things turn around finance. These are, what I'm going to say is I would say, in the second line of fire. It's not what should be the principal elements of a system. I think it's a good idea to allow the IMF in times of crisis to borrow on the market and to provide last resort liquidity to central banks that have liquidity problems. And I think it should be done as liberally as central banks of large countries do in solving their own liquidity problems. I think this is doable. This should be done, and it will allow the IMF to become, as I said, the lender of last resort. I think it's better to do it that way than to rely only on bilateral swap agreements between central banks. But I hasten to say that, in my view, this is not a reform of the international monetary system. It's a band-aid, which is nice, allows more financing. There are other ideas that seduce technicians, and they gravitate around the SDR. Personally, I'm not sure that this unit of account is a true answer to the problems posed by the existence of one de facto international currency, which is the dollar. I think the dollar is the dollar because of the width and the liquidity of its market. I'm not sure that the potential of the SDR to become a true market currency is very big, but maybe I'm wrong. Maybe it could become bigger. And then you have other more utopian ideas that would be to create a sort of an international currency made of certain national elements, but that of course would only work if the currencies were linked by some compulsory principles, because if they float against each other, it's a non-reform. So if I finished here, you would be extremely disappointed, because you would say this gentleman has explained that the gold standard was the only system that really worked. After the war, it worked a bit, but not for a very long time. And afterwards, the floating system has been, in a way, accaparrated by countries who do what they want, and the system is chaotic. And you can sprinkle a few little things, a little more money by the IMF and SDRs, but that is not going to go very far. But I have a conclusion, Martin, which I think you will like to ponder, even if you don't agree with it. And my conclusion is that if you believe the truth of what I said on monetarism being hampered by the enormous expansion of credit, then logically, in order to address the instability of the financial system and the crisis, which is a manifestation of the absence of a system, then you have to look into the ways of moderating credit expansion when moderation is the order of the day, or fostering credit expansion in times of recession or depression. Now, in order to do that, you have to have a macro, I don't like the word, but I use it because it's easy. You have to have a macroeconomic, financial, regulatory system that looks at the system, not only FSA looking at RBS, or not looking at RBS, by the way, would be more correct. But you need to have a system where you have these macroeconomic pundits who observe nascent bubbles and crises and things, and then decide, but with a geographically, I would say, fine-tune way of doing things, and then decide to have anti-cyclical provisions, higher capital ratios for certain types of lending, reserve obligations, loan-to-value rules in order to avoid excess borrowing by borrowers, etc. You need to go back to a system that provides a macro, translated in micro rules, of course, a macro vision of something that becomes then a workable, I wouldn't say monetary system, but at least a workable financial system where you don't allow these enormous bubbles to happen that way. Now, of course, the objection to what I say, yes, I finish. The objection to what I said, I'm finishing here, is that maybe the big states that govern the world will not agree to have this sort of regulatory system. I think nonetheless it is easier perhaps to do it that way because central banks have a certain credibility left and they might be seen as more technical in the way they act than political. Thank you.
Thank you very much. So I suppose this is a story of paradise lost. Rachel, paradise regained?
Well, I think it does explain, for me, very clearly why the French government decided to make reform of the international monetary system a top priority for its presidency of the G20. I have to say it wouldn't have been my choice. It wouldn't have been my choice because I think I am roughly where you ended up, which is I think that the financial reform agenda which has emerged from the crisis, and in particular the attempt to devise some macroprudential framework. That's the big prize at the moment, and and without the political energy which only the G20 can supply, I worry that that agenda is going to get a bit stalled. But never mind, I'll talk a bit, I think, about the international monetary system. I think Martin's probably right that it may have helped to fuel the crisis, but it's also worth pointing out, and we certainly spent ages before the crisis worrying about defects in the international monetary system and the trouble that it was going to cause. But it's worth remembering that we didn't have the crisis we expected. It wasn't a disorderly collapse of the dollar, which is what was waved in front of us for several years. In fact, the dollar turned out to be a safe haven, and the international monetary system, or non-system, turned out to be unexpectedly resilient. And since the crisis, imbalances have rather shrunk. But I still think that there are some strains there that should worry us. And the two-speed global recovery has put a lot of strains on the system, which continues to be really centred on the dollar. The fact is that policies which make sense, they do make sense for the US in domestic terms, are fueling inflation and asset price and commodity price booms around the world, and that risks at best possibly derailing the recovery, at worst prompting another crisis, and that is something that should worry us. I think reform is enormously difficult. If we're ever to get anywhere, we need to distinguish symptoms from root causes. And I think we also need to know where we're going, and I just wanted to say a couple of words about that. I mean, the big picture challenge that we're all grappling with is the emerging Asian giants, and not just Asian giants, I mean countries like Brazil. And I think historically it's pretty obvious that we are really not much more than at the beginning of a very difficult and dangerous transition from a very ramshackle international monetary system, which is very much dominated by the dollar, to a multipolar world, which is probably going to be based on several reserve currencies. And there was an interesting, I was thinking when you were talking, Jacques, about a very interesting paper which Chatham House put out, about 18 months ago now, called Beyond the Dollar, which very much realised your vision of what such a world could look like if we were prepared to agree on a supranational authority and using the SDR and all the rest of it. It's a very eloquent and well thought through version of what that world would look like. But I don't think there's a chance in hell of us getting there, to be honest. The political requirements, the geopolitical requirements of such a world are just simply beyond imagining at that moment. At the moment, there just isn't the trust, the communality of experience. I mean, it's difficult enough to make a world like that operate in Europe. So I think we are left in another world, envisaging a world which, the transition to a world in which China and the other major emerging markets will have fully convertible currencies, and that will run their own independent monetary policies, which are attuned to the needs of their own economies. And such a world may be more or less stable than the one we've got at the moment, but the immediate problem we face is how we can ensure that the transition to this world takes place as smoothly as possible. And I think past transitions from the dollar to sterling, from the gold, haven't been smooth. I think my reading of the interwar period is that it was such a transitional period, and it was a pretty dangerous one. And given the scale of international capital flows now, the chances are that this transition won't be at all smooth. And I think I think you can argue that at the moment That's not a shared vision that this is the world we're going to, that some of the larger emerging markets are resisting the transition, and the US itself has rather got its head in the sand. As far as emerging markets are concerned, the attachment to export-led growth strategies, the fear of destabilizing inflows, the arguments about the self-insurance and distrust of the IMF, they're all leading to the build-up of massive reserves. It's a symptom. It's a symptom of the slowness of the transition to a new world of convertible currencies and flexible exchange rates and independent, more appropriate monetary policies. And the worry of that is that it has destabilizing spillover effects on the rest of us. I think we'll come to that probably when you've talked, so I won't go on further about that, and the arguments are very familiar. It's worth just saying a word about the US, though. I mean, the US has always conducted monetary policy as if it was a matter of domestic concern only. And that, you know, is really at the heart of, I think, your grievance, and certainly repeated French grievance over the years. You know, the Fed has got a domestic mandate. I think in that it does differ quite significantly from the way the Bank of England regarded its responsibilities in the late 19th and early 20th century. But, you know, the situation is different. I don't think the Americans conceive of themselves as an imperial power in the same terms as we did. Whatever the case, nevertheless, the Americans have derived what's repeatedly been called exorbitant privilege from their position at the center of this non-system. And I don't think they understand just how big the exorbitant privilege is and how savagely it will run out. And the build-up of US indebtedness really does does pose quite a serious long-term threat to the long-term stability of the global financial system, and makes the chances of a smooth transition that much less. So if that's where we're going, just a word about what the role of the G20 and the IMF might be in managing that sort of transition. I think the G20, you know, its principal role has got to be to develop a policy dialogue which will promote an orderly transition. I think the crisis must have helped to improve the quality of the dialogue within the G20. It must have led to less lecturing, more mutual respect. I haven't been there since the 2008, but you could already detect a change in tone from Durban in 2007 onwards. And the crisis has generated a serious work programme which has providing a political leadership for the Financial Stability Board, the BIS, the IMF, and all the other international bureaucracies. And of course, working together is the best way of forging a common purpose. But the truth of the matter is that other than extreme crises, policy cooperation is a very slow burn business. It operates by building consensus, by peer pressure. It's maddeningly slow, and you often feel you're getting absolutely nowhere. But it can't be otherwise in a grouping which covers 85% of global GDP. As I've said, it's hard enough in the Eurozone. It's hard enough at the federal level in the US. You know, so we have to be realistic about what we expect of the G20. Nevertheless, the crisis has reinvigorated ideas about how to conduct monetary and macroeconomic policy. And I think the G20 and the IMF are both in the forefront of developing them. I mean, it's true that volatile capital flows complicate macroeconomic policy, but I think we have to start from the idea that they're a condition of life in a globalized world. We just have to learn ways of managing policy in that context. We can't be King Canute-like. We have to learn how the tides work. We can't rely entirely on the sea walls. I think there's an increasing recognition that we need to develop a package of measures, a toolkit which includes macroeconomic measures, exchange rate intervention, but also macroprudential policies. And maybe, and this is real heresy, against the context of everything I said when I was a senior civil servant. Maybe capital controls in certain closely defined circumstances. I think the tone of voice on capital controls has changed as a result of the experience, not just of the last crisis, but of the last decade. And I think we need to say that they're only likely to work in certain... I can't see them working in a country like the UK, for example. I could see them working perhaps in an emerging market in clearly defined circumstances, an emerging market which already has quite a lot of other kinds of controls. But I worry slightly about the pendulum swinging too strongly on capital controls. I can see it setting off a rather damaging round of deliberalisation, which I think we would all regret. So the big idea, though, is macroprudential policy, the use of prudential tools to limit system-wide financial risk. I don't know what is in that tool bag. I read the papers that have come out of the FSB with interest, and I think that there's an awful lot of vague ideas, but they are vague. They boil down to, you know, capital buffers and a string of different ideas. And I think we're a long way from having something which will really bear the weight that we think it needs to bear. And I would be one of my main priorities for the IMF to be working on this for the next few years. Just 2 words about the IMF before I finish. I mean, it's had, unexpectedly, a rather good crisis, despite committing all sorts of errors in the run-up to the crisis, both of commission and omission. And I think it's done itself a lot of credit by admitting those errors as well. It's emerged with a new sense of purpose, as well as enhanced credibility, more resources, a more flexible toolkit, and I think it is playing now a key role in developing thinking about new approaches to policy. I don't know whether it's done enough, though, and I'd be interested in what you've got to say about this, to build trust outside the G20, in the G20 members outside the G7, among emerging markets, and particularly in Asia. I note in some of the publications a slightly less deferential attitude to the US and other major advanced countries, which I think is probably helpful. But there's an awful lot more that the fund needs to do to behave and to staff itself as if it belonged to all its members. And it must do that if it's to play a full role in managing the transition to a new world.
I don't think that I could describe this as paradise regained, but maybe maybe a world we could just about bear to live in. Very British response. Let's muddle through because there's really
Always done before.
and it's worked quite well by and large. The French, of course, being Cartesian, want a proper rational solution. I'm going to now find out. We're now going to find out what the Chinese perspective on all this is, which is, of course, vastly more important than ours. It's for you, Gao Haihong.
Thank you. I think Rachel just mentioned the Chatham House report, Beyond the Dollar. So what do we look at beyond the dollar? And you are absolutely correct. The argument is somewhat centered on Chinese currency, RMB. So I'm just going to give you a brief thought on the perspective for the RMB to become an international currency. So currently, I think RMB is neither a reserve currency nor an anchor, and far from a vehicle. It started being used in trade settlement and recently in a bond issuance in Hong Kong. So what really matters is its potentials. And I think there are a number of conditions for a currency to be an international currency, like economic size, convertibility, or stable intrinsic value, central bank's credibility, or developed financial market, and some factors beyond economy. So I think China actually meets one or two. but overall it is still in the progress of making. And there are clearly a number of the obstacles. One is limited convertibility, as many people concerned because of the China's capital control. And actually there is a debate on to what extent that convertibility matters. And some people believe that a certain degree of the currency internationalization can be achieved under limited convertibility. And even in some extreme case, the regulations on the use of domestic currency could create incentives for the offshore market, like what happened in Germany for its Deutsche Mark in the 1960s. So, but the others don't think it's possible to have the currency to be internationalized under the accountability. And actually nowadays, how to balance between the currency internationalization and accountability becomes a big challenge for the Chinese government. Because to have the capital account convertibility too fast is not an option for China. So second obstacle is China's sluggish domestic financial market. I think the bond market actually is regarded as a key indicator for the currency to be used internationally. It's about potential, but unfortunately, China has a very small-sized bond market, and this is a big barrier, and it won't be improved in a short period of time. And the third one is the probably some people don't agree with it, is inner flexibility of the exchange rate. So again, if you relate the exchange rate issue to global imbalance, it could raise huge debates and blames. But if you relate it to currency RMB internationalization, it tends to be something quite certain. Because in a circumstance of a free capital flow, a flexible exchange rate actually could help central bank maintain its autonomy of the monetary policy, and which in turn could ensure the credibility of the central bank's policy and hence the credibility of the currency. So if that is the case, I think the RMB internationalization will certainly bring along with the RMB exchange rate flexibility. So what do we need to do is just to wait, be patient. And there are a couple of the debatable issues. One is that should RMB internationalization a policy objective? Actually, in the beginning of this year, there are some bold moves taken by the government, such as to invite foreign banks to be involved in RMB loans in the interbank market, and also allow the RMB to be used in the outbound direct investment. So Chinese government seems to have a ambition to push RMB internationalization, but that actually gives a wrong impression that the RMB internationalization has become the government's policy objective. So I think actually China is trying to learn the experience of the Japanese yen internationalization, that because in the 1990s, Japanese government used to give a big push to yen internationalization without success. So I won't expect any possibility of big bang just for the purpose of the currency internationalization. And another debate issue is that is there an optimal sequencing for our RMB internationalization? So actually a step-by-step approach to make RMB accessible actually has become a consensus in China, but sequencing remains debatable. And you know, the Chinese way of crossing river by touching stone applies as usual, but with further opening capital account, I think it tends to be more difficult to do it without a clear agenda. So to sum up, I think the Chinese government gives no firm answer to what is the agenda of the RMB internationalization, and this reflects that the government actually be fully aware of the risks and the limitations. And the good news is that they know what they're doing and know it will take time, and if it can be done, the landscape of the international monetary system will be changed. I'll stop there.
I think that's a very interesting and important statement, which is very much in line with what I felt for a long time, that the true internationalization of the renminbi as a reserve currency is rather a long way away. One of the points which I think emerged thought about in a previous conference, which I was also moderating with Jacques de Larosière at the Banque de France, I pointed out the Chinese attitude to the dollar is in some ways very similar to that of France, in that they like to be stable against the dollar. Ideally, they would like a stable dollar arrangement, but they would really like the Americans to behave in a more responsible manner. Which is, I think, a pretty hopeless hope. And because if you tied yourself to the Americans, why the hell should they care about what you're doing, what it does to you? You've lost your degrees of freedom. But the other thing the other aspect I was just thinking in your remarks, there is in your view, in your description of the way the Chinese government and authorities will approach convertibility, it is very much this sort of muddling through. It's a process of taking small steps and seeing what happens. And it seems to me a dominant characteristic of Chinese policy making, and it strongly reinforces Rachel's view that a grand international schema for running things centrally is, to put it mildly, unlikely. That now, let me give Jonathan the last word and summarize it all and give us the right conclusions.
Well, I will try and be very brief because I wouldn't want to stand between people and their what I've no doubt is excellent champagne and canapes.
We're already going to postpone that, don't worry.
And rather than reading my prepared remarks, I will try and react to what other participants have said. In particular, I think it's quite. I'll try and kick off where Jacques left off, as it were, where I think essentially his conclusion, which I think Rachel broadly shared, was that any fundamental reform or attempt to produce a new international monetary system as such was doomed, and I think that's probably something the entire panel shares, but that the best feasible reform of the international monetary system that we could get was macroprudential. A proper set of macroprudential policies applied either in individual countries, internationally, or some combination of the two. And that is, if you share Martin's analysis, for instance, that the crisis was largely produced by what you might call a toxic cocktail of the malfunctioning of the international monetary system, global imbalances, on the one hand, and failures of regulation and supervision in the financial system at country level on the other, then that's quite an appealing diagnosis, because it suggests that in principle you could if not necessarily kill, at least perhaps stun into acquiescence two birds with this one stone of macroprudential regulation. The problem that I see there, though, is that as far as I can tell, while everybody, and Rachel pretty much said this as well, that everybody talks about macroprudential regulation, but there isn't a lot of consensus on what it really means. And to me, what I tend to come away with these debates is they're not just a consensus on how macroprudential regulation should work, but even the lack of a framework to debate. It's quite difficult for even a reasonably well-informed observer to tell who is arguing for what and why, let alone who's correct. And for instance, I found it slightly difficult to I connect Jacques' remarks just now on macroprudential with his FT article of a couple of weeks ago, which seemed to me to emphasize more the role of individual of supervisors in individual countries. Maybe that's slightly unfair, and he might want to react to that way. But going to macroprudential regulation, should we be focusing on capital requirements or on structural remedies? Is the mistake that we're letting the banks go back to their old ways, or should we be worried about the next crisis from coming somewhere else in the system or in the shadow banking system? I'm not sure what the answer to any of these questions are, but more worryingly, I don't think most of the other participants in the debate know what the right questions are, let alone what the answers are, and therefore I do see some serious obstacles here. Why is it that we turn to macroprudential regulation rather than reform? It's primarily because none of us think that in international coordination of a major reform to the international monetary system is likely to be feasible in the near future, and that's clearly true. The question is, and I think this is an open question, is to whether the necessary degree of international coordination is more likely on macroprudential policy than it is on reform to the IMS. And you can see there are some trade-offs here. In some ways, it's politically somewhat easier to coordinate macroprudential policy than it is monetary policy. On the other hand, the pressures from, in particular, the lobbying of the banks and the financial system as a whole are perhaps rather greater on the macroprudential side. So while the G20 was able, because of the political momentum behind it and because of the crisis atmosphere, to make quite a lot of progress in the first year or so of its operation post-crisis, I think there is an open question on whether it can sustain that momentum, and there is a very important role for those of us, I think, who comment on these matters to try and keep up the impetus to not, as I say, to define the final answers on macroprudential, but to try and raise the priority of this in the international fora, try and set the framework within which these questions can be asked, and to sustain that political momentum for macroprudential regulation that will actually bite both at a country and at a international level. Finally, I'm not a China expert by any means, but I think there's perhaps just one aspect of this that I think is relevant to the Chinese dilemma in working out what to do and how to approach the international system. Haihong referred to the fact that you have to cross the river one stone at a time, but there's an equally valid maxim. I'm not sure where it originates from, that you can never step into the same river twice. And I think that's relevant here. The river, by the time you've finished getting halfway across the river stone to stone, it may well be quite a different river that you're trying to cross. And so the need not just to define a destination, but to approach it with a degree of flexibility, and to be able to concentrate not just on finding the next stone, but also in participating in these debates on what the river ought to look like and which direction it's going in, are also something that Chinese authorities need to keep in mind. And I'll finish on that, I think.
Thank you very much. That was Heraclitus. I remember that, sorry, this is incredibly long time ago. I did this as a special paper. And there was it's actually relevant. He is supposed to have said you can't step in the same river twice, to which my very clever philosophy teacher responded by saying, actually, you can't step in the same river once. I won't go further into that. I'd just like to make it's quite an important point, actually. I've just made 3 concluding little points, and then I'm going to throw it over to the floor, and I'm going to postpone the drinks by about 10, 15 minutes. So there'll be plenty of time for you to drink, as long as you drink fast. I'm not suggesting that. That is, ignore that. Ignore that remark. The first is, having spent a little time recently thinking about it, I'd just like to underline the fact that making macroprudential control of the financial system globally work is in my view, going to be at least as challenging, if not more challenging, than reform of the monetary system. It's just a staggeringly difficult task, conceptually and practically, at many different levels. The second point I make is that, which I don't think has been brought out quite as clearly as it might have been, is obviously since 1971 we've operated in a status of what can only be described as an international monetary disorder in some sense, the product of the interaction between national monetary policies, exactly as Jacques de Larosière described. But the point I was trying to make at the beginning is that over the last roughly 12 or 13 years, it's evolved in a particularly interesting and way, in that the major developed countries, or in the case of the Euro system, groups of countries grouped within the Euro, are operating in a world of floating rates, domestic monetary policies oriented to inflation control under independent central banks. And large parts of the rest of the world, including some very obviously China, but also other emerging countries, are operating in a world of quasi-fixed exchange rates, or at least heavily managed exchange rates, with very, very large currency interventions and enormous accumulation of reserves. The point I make about this, not only is this a very important system to analyze, because the countries that are intervening are so large, they really do have an effect on the whole system. But the point I would make is that this is really not the system that 13 or 14 years ago, after the Asian financial crisis, most economists in the developed world would imagine we would now be in. It's a strange evolution. And the final point I would make is that this sounds almost Panglossian, but okay, we've been in total monetary chaos in some sense, in the way I've described it, at the international level for 40 years, and have emerged into this very weird hybrid system. But in some ways, you could argue it hasn't worked that badly. Not because, clearly we've had lots of financial disasters and chaos, and lots of misery has been inflicted on people, but it's also seen an incredible globalization of the world economic system, the rise of emerging countries with astonishing success. It has not prevented this. We've had a very long period of economic expansion globally, with some, of course, disruptions, faster than and almost as long as the whole classical gold standard system, which actually lasted for a little over 40 years. So this non-system has survived as long as that. So I suppose my feeling is not merely that muddling through is okay, but that maybe chaos works. And we shouldn't, this constant desire to go back to what we're not going to go back to anyway is just sort of something that appeals to intellectuals, but maybe we should really forget about it. And that actually is what was taught by my teacher, what my teacher taught me, and I think it's very much what I think. So I'd make those little remarks myself. I'd like to throw it open to the floor.
None of you mentioned Basel. I got one mention in a list of other international bodies, I think by Rachel, and what it's trying to achieve. Can't what it is going to achieve, or we hope will achieve, overtake what happens at a higher level in reforming the non-system, and at a detailed level with Dodd-Frank, Émié, and MiFID?
Let's go a bit further then, if there's questions, Ray. I'll start with you, Rachel. How far do you see the regulatory developments in the Basel process, FSB and so forth, as a substitute for monetary reform or a complement to it?
I mean, it always used to be the final paragraph in those articles written by Bill White from Basel, before the crisis, when he was telling us that we were too narrow in the way we thought about monetary policy. And it's a compliment. It's an attempt to invent some more policy instruments. I don't think it's quite what you're doing on the Independent Commission for Banking, actually. It's about things, to me, it's like trying to modernise the instruments we threw away 30 years ago. There's a lot of that in it. Corsets and capital counter-cyclical capital requirements, and all those extra monetary policy instruments that we used to have, which we chucked out along with exchange controls now. And so I think it is an attempt to have a few more strings to the monetary policy bow, really. I mean, one of the big difficulties about it is understanding what you mean by systemic risk in the financial system, trying to get your mind around the build-up of systemic risk. That's what we all missed, actually, in the run-up to the crisis. And, it's going to involve an enormous effort of data collection and analysis to get your mind around identifying the problem to which you're trying to respond. The response is going to take the form of counter-cyclical capital buffers. It may, also the other thing which is in macroprudential is, as I saw someone on the list from the accounting bodies, is getting some more sensible accounting standards which don't accentuate the pro-cyclicality of the existing system. Yeah, I know it's giving us some more strings to our bow, really. How it fits with monetary policy is another jolly interesting question.
It is.
So, if it isn't,
this
something
is why I was
quite
asking
separate.
you. It is.
The institutional framework in which all this is going to take place is another big question. I mean, within the Bank of England, they're going to have 2 committees now. It's going to have overlapping membership, but actually, you need the same brain to think about it. The whole thing's got much muzzier. I mean, this lovely world that we lived in up to 2007, where you had, one instrument, one clearly defined policy objective, and you had fiscal policy done at one end of town, and you had monetary policy in the MPC, and that's all gone. And it hasn't gone because the individuals failed, but because the intellectual framework has been rather fractured.
I have to say, I can't see why. It seems to me actually the other way around. That it's obvious that the new macro-prudential responsibility should be in the MPC. I don't see how you operate them separately. But probably that takes a little away from it. But it seems how you run the interest rate in this policy separately is not obvious to me.
I don't see how you can run them separately.
May I ask a question in this context of you, Jacques de Larosière? I know that you've been somewhat critical of the capital raising part of the Basel process. You've talked yourself very firmly about making macroprudential work, but this is seen as yet another capital raising exercise. You presumably have a different view of how it should work if it's not going to be a capital raising exercise or capital adjusting exercise. How do you see this macroprudential sort of idea working, since you raised it in your speech, and how would it fit with what they're doing in Basel?
Yes, I'd like to explain this very briefly. What I am criticizing in Basel is the sort of very general action that consists in raising capital requirements globally on the banking system without distinguishing what are really the risks involved and the impact of these increased capital requirements on different models of banking. For instance, universal banking model is more affected by those general increases than other banks. So this is a criticism that I maintain. I think that it is more intelligent to, we say modulate in France, you say fine-tune, the capital ratios. I'm not against increasing capital ratios on certain types of risks this is being done by Basel, by the way. As you know, trading operations are much more weighted now in the risk weighting thing. But I would go further, and under certain circumstances of overheating, I would not at all discard increasing reserves, increasing capital requirements in certain sectors of things, but not in a general way, in a pointed way, or do things that we used to do and are less cumbersome than raising capital ratios very high. It's, for instance, to look at what a bank should lend to a customer in relation to, for instance, the house, the price of the house that is being the object of the borrowing. If you said, for instance, to a candidate to borrow from a bank to buy a house, well, you're going to have to put 20% of the value of that house in cash, and then we'll finance the 80%. This would avoid, I mean, if you want to do that through a general capital, yes, you could arrive at 13 or 14% capital requirement, but you would kill the whole economy. That's what I'm saying, and I'm going to demonstrate that in another set of articles, unfortunately for you. But I think it would be more intelligent to do it in a more sectorially based way, as we used to do it in the old days. And I think it's perfectly consistent with Basel. For instance, anti-cyclical provisioning is something that makes a lot of sense and can be done. So, and then you release things when situation changes to the south. So I really think that we are putting too much emphasis on the general percentages, and I'm answering our friend Portes on this, and not enough on fine-tuning. Though this is my view, and you know, I don't ask you to share it. But what you don't say in your different statements is something that really intrigues me. It's that the crisis was really caused by the enormous increase in leverage by the banking system, and you have to put your energy on that issue. And I think it is easier to do it through credit, if you will, limitations, and you have, as you said, Rachel, a toolkit to do that, than only to do it through, you know, higher capital ratios. Because if you do it through higher capital ratios, you can, but it's a bit like interest rates. It's then you really the overkill is a danger.
I see the point in terms of macroprudential adjustment, and I see the point in terms, certainly back to the future and sectoral, but obviously it goes without saying, the leverage of a bank is simply the reciprocal of its capital ratio, so you can't deal with one without the other. There may be more sensible ways of doing it, and maybe they should be more aggressively counter-cyclical and not so concerned with the level. But the issue still arises. I mean, that's obviously, that goes without saying. I do want to move to one, possibly the final question, but it's an issue that you didn't touch on, Haihong Gao. If I could talk to you, the Chinese government, or at least the governor of the People's Bank of China, has spoken a lot about the role of the special drawing right, of the SDR, in the monetary system. And nobody actually is even, which is fascinating, because usually in any discussion of the future of the monetary system, somebody mentions the SDR, if only to rubbish it. And so I will be interested in, and then one of the subjects, I've just been in Washington last week, and one of the subjects they're talking about is putting their RMB into the SDR, which would be in some ways, given your discussion of convertibility, a little strange, since it was reduced in size, number of currencies, well, about 20 years ago, I can't even remember now when, in order only that the currencies in it should only be highly convertible. What do you think the Chinese government's policy towards the SDR really is, and how important from the Chinese government's point of view, is this set of issues? Or is it just trying to warn the United States that there are alternatives to the dollar? Would you dare to answer this question?
Well, actually, you have already given the answer.
Okay,
right.
then.
Anyway, okay. Well, yes.
The ideal
of course,
question.
Yes. Of course, to put RMB into the basket of the SDR is something that discussed days ago, and I think there is quite divergent opinions on this issue. One is negative, because some people has a fear that this could invite external pressure for the Chinese government, like to have a currency convertibility and to have the currency revaluation and rapid domestic financial deregulations. So this somehow became a fear. But the opposite opinion is quite positive, because some people believe that this could help RMB to be recognized by the world, which is quite helpful for the RMB internationalization. So I think actually the Chinese government is not convinced what is the benefit and to what degree that China is not pushed too hard, so that the China can keep its own pace of the reform and opening. So this is quite something has different opinions, and there is a debate. And probably you are right, Martina. It can be very certain that it's just a warning that, we can do something if, the US dollar is something that we want to damn, and this could be a choice.
Okay.
Did I answer your question?
Yes, it does, rather.
Okay.
I'm going to give you, I think, since there were any questions, I'm going to give you, Jonathan, the last word. What should the participants go away with?
What should the participants go away with?
A feeling of despair or hope?
No, I think not a feeling of despair, but a feeling that that there are some, the crisis is not over. Indeed, it may not even have begun in some sense. That we have not the basic twin problems of the incoherence at best of the international monetary system and the inadequacy of financial regulation neither have been addressed, and the prospects of a grand bargain of the sort that my former boss, Mr. Brown, was so keen on are very small, and the prospects of a Cartesian reform of the international monetary system to deal with them are equally small. But that is not a reason for giving up. What we need is to try and rebuild the consensus that did exist briefly around the time of the crisis, that these problems are clear and present dangers, if not now, in the next few years, and do the painstaking and incremental and, as Rachel says, likely to be maddeningly slow work that's necessary to correct them. I would only point, for example, to your interim report yesterday. I may not agree with every word of it, but it is, and I'm sure you didn't either.
Who possibly could?
But it is a good example of the sort of serious, analytically based work that says, look, there's some real problems here. Here are some roads towards a solution, but we cannot let the momentum slip on this. And that sort of work, both at national and international level, is what we should be turning our minds to.
Thank you very much. I'd just make 2 points in conclusion. we have the drinks. I mean, obviously, the main conclusion, said in many different ways, is that disorder rules, and it's about managing it, or at least preventing it from overwhelming us, which we seem so far to have done. I do think it's the perils of Pauline route to approach to economic management, but somehow we survive. And I did stress the point that if you look at the world economic performance under this chaos, we seem sort of somehow to keep going. The second point I would like to underline, which I thought was brought out very, very clearly in the discussion, which is again completely obvious, but its significance, I think, it's very difficult to grasp, is that we are in a time of the most profound transition in the whole structure of the world, and of which the monetary system is in truth just a very small part and a very small reflection, though history has suggested in the interwar years that it can be a pretty devastating one. Again, I would suggest, and I've repeated this in many contexts, if you look at the nature of the transition, its astonishing speed, the extraordinary divergence in standards of living, in history and culture of the powers involved in this, we are actually doing incredibly well. So far, as I always then end, so far. But if you compare it with the transition between the UK and the US, which were, after all, powers much obviously similar to one another, speaking at least in theory the same language, and the credible mess that was made of the end of the First World War and the interwar period, I think by those standards, the institutions we have of various kinds, and indeed even the innovations in the crisis, for which Gordon Brown actually does deserve, I think, significant credit, have been remarkable processes of accommodation. And the very fact that the Chinese government is so cautious, so careful, is, I think, actually a source of a tremendous encouragement in the possibility of managing all this. Certainty is incredibly dangerous in situations like this. So that's great. That's also encouraging. So those are my two concluding remarks. I think we've had a very interesting presentation of these issues and far more confidence in financial regulation than I ever believed I would hear. And please thank the panelists in the normal way and then enjoy your drinks.